welcome to another edition of Inside the Exit. I'm your host, Drew Brantley, joined today by Bob Frisch.
Hello, Drew.
Welcome to the show again. So today we're going to talk about how much is your company worth? How much can you sell it for? That's a question we get a lot. You know, can I get this amount? How much do you think I can sell my company for? It's usually one of the first questions that people ask before we even really know anything about their business. You know, unfortunately, valuing companies is a pretty tricky topic. There's a lot that goes into it. There's kind of where's the market right now? How good is your company? How have you set your company up to date? So let's talk through some of the things that can influence valuation and might dictate how much you might or might not be able to get for your company. Now, the first thing that I want to dig into is, before we even get into that, is I want to address this topic of multiples, because we get this a lot when we talk about this, and people will say, oh, I want to sell my company for, 10 times revenue or 5 times revenue. And, sometimes we say, oh, well, I read an article that Google bought a company for 30 times revenue, or, Coke bought a company for this. Most companies in the lower middle market and the middle market are not bought off multiples of revenue, especially if you're reading about them in the Wall Street Journal, the New York Times, or one of the business journals that are out there. A lot of those transactions are really big. They're bought by strategics, and strategics oftentimes are willing to pay exorbitant prices for very specific reasons. Now, your company might fit into that, absolutely, but I would say it's a very small minority of businesses that sell for multiples of revenue. Most businesses sell for multiples of cash flow or EBITDA. EBITDA, earnings before interest, taxes, depreciation, and amortization. Warren Buffett's been great about pushing this as a metric to kind of level out the playing field for valuing companies. And so that's oftentimes the metric that people will use. It's something that if you're currently not looking at that number in your financials now, talk to your accountant or whoever's doing your books and find out what that number is, because that is going to be an important number you need to know. So most companies, when they're sold, it's based off that cash flow or EBITDA. Sometimes it's based on assets, depending on the size of your company, or those assets are included in there. But a lot of times it's a multiple of that number or those things as opposed to revenue. So I hate to disappoint some people out there. If you're talking to a buddy playing golf or playing tennis and he says, well, I think, you should sell your company for more. They don't always know what they're talking about. So just want to kind of level set a little bit in terms of how the market interacts on that.
Yeah, it's so true. It's going to be on the amount of cash flow you produce out of your company. That's just so important. Yeah, there's some strategics that are going to look at you, and if they take your company and expand it countrywide, let's say you're in a region and they know they can blow it out across the country, well, maybe they're going to pay up for it. They may look at the cash flow, and maybe they'll look at the potential revenue they can get, so give you a pretty astronomical price. That happens every now and then, and there's no doubt about it. They're looking at it from a whole different angle of the way they're going to take your smaller company and put it into their machine, their distribution, whatever it may be. The Coke example is a good idea, and then they're going to blow it out across the country, if not across the world. So that's a whole different equation, but almost all of them are done on a multiple of the existing cash flow. And right now, EBITDA is the best measurement we have of that. If you have high capital expenditures, okay, it would be EBITDA minus the capital expenditures or minus CapEx. Warren Buffett likes it. It's not the best absolute end all and be all, but it is the best we have right now.
Yep, absolutely. So let's talk about other things that influence. Now, let's start kind of broad brush generic, and then we're going to dig down a little bit in terms of things that influence valuation. So in general, the bigger the company, the more you're going to be able to sell it for. The smaller the company, the less you're going to be able to sell it for. I realize that that's a generic statement, but if you haven't seen our video about good company to own or good company to sell, you should go and watch that video after this one, because one of the things that we talk about is the difference between a tuck-in acquisition. So maybe you're building your company and it's a good tuck-in for another company, versus a standalone platform. In general, standalone platforms are going to they're going to invoke a little more of a premium from a price perspective than a tuck-in, because usually they've got more infrastructure in place, management team, less risk from a customer concentration, a lot of other things that people look at, when valuing a company. So, platforms tend to warrant a higher price than a tuck-in does. So, general size of the company, how much you make top line and bottom line, and then also the whether your company is a standalone or a tuck-in, those are two big things that can influence valuation.
Yeah, there are all sorts of different things. One thing that can influence you, the seller, that we want to be very cautious about, there are ways to measure the value of a company. Discounted cash flows. You go out into the future, you discount the cash flows back, you put a multiple on. There's ways to do it. There's comparative analysis. How much did a very similar company sell for, in your industry? What you have to be careful about is your company's distinct and different. So when you look at some of these valuation exercises for what you think your company is going to be worth, and someone sold for 10 times the EBITDA, and you come and think, well, why is somebody telling me mine's only worth 6 times? Well, there may be a very big reason why that one sold for 10 times. Maybe it was 10 times bigger than your company. Maybe it was in selling throughout the whole world. Maybe it had a better distribution. Who knows why? But you got to be very careful about. One of the things we see all the time, and this is one of the big distinctions here, we're operating in the private market. There isn't a public market. And Drew will talk about this, where the public market valuations on companies in the public market, especially the larger ones, but also the medium ones if you have it, are very different than the valuations of the private capital market.
Absolutely. No, that's a really good point. Public versus private, again, people read in the newspaper. A lot of the stuff that you read in the newspaper is done in the public markets, or it's things that are kind of inflated valuations. And it's just not always realistic for the average business or business owner in the lower middle market or the middle market. It's just reality. So, just be aware of that. Just because Google bought a company for a certain price doesn't mean if you're in the same industry, you can sell your company for the same price. So the next thing I want to look at is kind of what can potentially increase the valuation. So maybe, you're a couple years away from wanting to sell, or 5 years away, but you want to begin thinking about, how can I begin now to prepare my company to be able to be worth more in the future when I do want to sell it? So here's some things that can increase the valuation. First thing is looking at the customer concentration. I know we've talked about this in a few of our different videos, but the less customer concentration, the better. Buyers look at it from the perspective of, if I'm buying this company, is there risk that if one or more customers goes away, I'm going to lose a large amount of my revenue? In general, if you can have customer concentration, meaning that there's not one customer that's generating more than, call it, 20% of my revenue, that's a good thing. The less, the better. So the more customers you have, the better. So the more you can do to build in more customers, that helps. The other thing is, if you think about your management team and having the right people in place to really help grow your company, if you're going to walk away from your company, it's going to cost a buyer money to hire somebody to put in your place. So that typically, potentially, might reduce the value that somebody's willing to pay, because they've got to pay more money to hire a good person to come in. So do you have the management team or the people in your business in place to really run it going forward?
Yeah, that's important. And some of the things you'll say, well, when I go to sell it, I'll just tell them. Well, let me tell you, telling them something that could be done versus doing it before they come in is incredibly important. We had a company that we were looking at, and the seller said, well, I'm just going to increase prices, but I don't want to do it right now. The new buyer can increase prices and everything. Well, the problem was the new buyer was sort of sitting there going, well, how do we know those prices are going to stick? Oh, they'll stick, says the seller. They'll stick. I know they'll stick. Okay, well, wait a second. There's a big difference to that buyer. So as a result, the seller didn't get a lot of credit for that, if any, because wait a second here. First of all, if you thought they were going to stick, why didn't you implement them now? Number one. And two, why should we have to implement them? You're the one with the relationships. You're going to be exiting stage left. Go ahead and implement the price increases. So there are a lot of things that, as Drew pointed out, that you really have to think about as a seller. What's going to be meaningful and help the valuation of my company.
Yeah, and that one, the seller wanted somebody else to do the dirty work. He didn't want to raise prices. He hadn't done it in like 10 years.
Exactly. Yeah. So not that it wasn't possible, he just got no credit for it. I mean, it's really one of those. Mm-hmm.
So the other thing is to think about, what's defensible about your business, or what's unique or differentiates you from your competition. So if you think about your business, ask yourself, how easy is it to get into your business? How easy was it for you to get into the business if you started the company, or maybe you inherited the company, and so, typically businesses that require a lot of capital, maybe, manufacturing companies or things that require unique, specialized equipment that's really hard to acquire, those companies have a more defensible position, meaning it's harder to get into, or maybe it's a regulated environment. And so there's a limited number of people that are approved or certified or whatever to be able to do what you do. Those things can warrant a higher valuation than a company that has a low barrier to entry, meaning that maybe Bob and I, at $100,000, we could go out and buy a truck and start doing what you do. That's a low barrier to entry. And so the more defensible that your business is, the better the valuation or the higher price potentially that it's going to warrant.
Yeah, it's funny. A few years ago, we were working with somebody, and the buyer came out and said, I like your company. It has a great moat. And we thought, moat? Yeah, it's a wonderful moat all around it. Nobody can get into it. It's a beautiful moat that's been built around it. So we picked up that term. We really liked it. It was a number of years ago. But does the business have a really good moat around it? It's another way of saying it. It's a wonderful analogy to look at.
Yep. And again, look, as with all these things that we're saying, I know we keep throwing this qualifier out there, but it doesn't mean you can't sell your company if you don't have these things in place. We're just highlighting the difference between things that can kind of increase valuation or might not draw as much of a premium as other things in other companies. So, all right, so we've gone through a few of them. Let's look at a few other things. If you look at what it is you do, how good are you at doing it? And maybe another way to think about that moat is competition. What's the competition itself like? So not just how easy is it to get into your business, but is there anybody else doing your business? Maybe there's nobody else, maybe anybody could do it, but just nobody's doing it. And as a result of that, you've got a moat, from that perspective. There's just no competition maybe locally or geographically in a region, or you've got a unique niche in an industry and a big head start from the customers. There is something to be said for first mover advantage. If you look at a lot of companies that were kind of the first ones into an industry, or the first ones that were into a market, take Coke, for example. One of the first soda companies that was out there, and as a result, it got a huge jump on the market. And there's a lot of different, soft drink companies or soda companies or energy drink companies that have come into the market, but none of them have ever been able to catch up with the leader in the market. Facebook, another great modern example where if you think about social media, it was really the first, well, I guess MySpace was a preceder to that, and there were a few others even before that, but in general, Facebook was the first big social media company that was out there, and as a result, they got a lot more of the market share, and it's harder for the competitors to keep up. So there is something to be said for, even if other people can get into it, being kind of the first in, and so if you're big enough or have enough market share, it can give you a real advantage.
Or have a better mousetrap. A lot of times, MySpace was a good example. Facebook came out with a better mousetrap. So if you have a better mousetrap than somebody else, that's valuable. They can look at the other person, see that yours is much better, and therefore that valuation goes up for your company versus somebody else. All these things make a big, big difference in the total valuation. That's why it's so hard to sit there and say, X and Y. We're constantly working on companies that we say the marketplace will tell us. That at the end of the day, we think this, we all want that, but the marketplace is going to sing. And the marketplace is a very, very truing up. What's the expression I'm looking for? To true up what you think your valuation is, the marketplace will let you know. And one of the things that's very important when you sell your company, to go into the marketplace, to go in and talk to a number. If you're going to sell your company, you don't do yourself a disservice by saying, well, Joe down the street offered me Y and I'm going to take Y. I mean, if you want to sell to Joe, that's fine. If you have a reason for selling to Joe, maybe he's your brother-in-law. I don't know. Maybe he's just a really good friend. But if you're really serious about selling and getting a high valuation, then you really got to go into the marketplace.
Absolutely. Take a house, for example. I could think my house is worth $5 million, but if somebody's only going to pay me $500,000, then my house isn't worth $5 million. And so to Bob's point, the market at the end of the day is really going to dictate the value of your company. And on that note, I do want to mention, I've heard from multiple sellers or business owners that, they've talked to different investment bankers or brokers, and they promise a lot of things. I would really caution you, if somebody tells you that they're certain or they're really confident they can get a certain price for you, for your company, I would be really hesitant and kind of second guess what it is they're saying. A great example of this is we had somebody that came to us recently, a business owner, and he went through a sale process, and the broker that was involved told him that he likely was going to be able to get 10 times for his company, 10 times EBITDA. And he came to me, he knew who I was, and he said, look, I just want to bounce this off of you and kind of reality check it. And I told him, I said, look, if this guy says that he's confident, it might be worth taking a swing at it. He really might know somebody that would pay it, but I would ask questions before you take it to the market. I said, because my experience is a company of this person's size and what they do would not warrant 10 times. I said, the likelihood is you're going to be closer to between kind of 4 and 6 times EBITDA would be a range that I would think probably is a little more accurate for his size company. Now, again, doesn't mean he can't get more, doesn't mean he might not get less. But again, the market at the end of the day is going to dictate it. Now, the story turned out that he wasn't able to get what he thought for his company based off what this guy had said, and it ended up being a little more in line with kind of where I thought it might end up at the end of the day. So again, in that case, I was right. Other times, it might not be the case.
And not a company we represented. Don't get us wrong. We just think it's very important if we're going to help somebody out, you the seller, and this videos and our work is all geared towards the sellers. We want to put realistic brackets around it. Now, do we shoot for the 10 times on something? Sure. But are we going to be realistic about the fact that most of the companies in your venue are selling somewhere in that 5 range, maybe a little bit lower, maybe a little higher, maybe that 4 to 6 range, but that's a realistic approach to it as opposed to promising 10 times. Could we get 10 times? Have we at times? Sure, we've gotten that sort of out of market exception to the rule. That happens. Don't get me wrong. You hit the right buyer at the right time, and they have to have it for tax reasons, if nothing else sometimes. That happens. But on the other hand, shooting straight and giving realistic expectations is incredibly important. When you go to the marketplace, yeah, you tell somebody maybe I want 8 times for it, I want 10 times for it. They're going to correct us very quickly sometimes. But on the other hand, you might end up getting that. But at the same time, to the seller, the most important thing is to have. I think what Drew is not telling you is that same person came back to him, and what did he say at the end of the day after going through a year process and having what you told him? Go ahead.
Yeah, so at the end of the day, when he came back to us and I followed up and said, so how was it? And he said, well, honestly, he said, the advice that you gave me allowed this to be a stress-free process for me. Had I not talked to you, even though you weren't doing the process for me, what my broker told me, none of what he said actually turned out in the way he said, but almost everything that I told him and gave him guidance on ended up being more around the reality. So as a result, he went in with kind of a set of realistic expectations, so he didn't get worked up one way or another. And as a result, he was able to go in with kind of contingency plans, so he didn't go in thinking he was going to get, to Bob's point, thinking he was going to get 10 times for his company. He said, okay, it'd be great if I do, but I'm going to be, realistic in that likely this is where the market at this moment in time is going to kind of judge my company.
Sure. So if we can offer sellers stress-free, to go through this process stress-free, boy, we have done our job in spades.
Absolutely. Mm-hmm. So I want to talk about one other thing that is really important that can influence the valuation of your company as you're thinking about preparing your company for sale, and that is kind of the financials and the numbers around your business and kind of who's in your business. And what do I mean by this? Oftentimes there's a need to clean up the numbers. If you've been running your business for a long time, look, I'm just going to say it. You might have employees that you should have let go years ago, but you haven't let go of. You might have people that are in your company that are no longer necessary. Maybe their position is currently being done by somebody else, but you kept them on board. Or maybe you need to reorganize divisions or parts of your company or how people operate to be more efficient. When you look at the numbers of your company and really what's happening at the end of the day, people are going to look very hard at a couple different numbers. They're going to look at the gross margin. They're going to look at the SG&A and the COGS and what is it costing for you to do business. And if they see that these numbers fluctuate a lot from year to year, they're going to ask a lot of questions and say why. Or if they see that all of a sudden, that these numbers are going downward. Downward trends are not good things to see in your numbers when you look at it on a multi-year basis. But if you see upward trends, that's what people are looking for. So as you look at your financials, look with your accountant and look at things like the gross margin, look at the cash flow or the EBITDA margin, look at things like your COGS and the specific line items within that, and ask yourself, what can I do to improve these? What can I do to increase the cash flow of the business today? And look, it's only going to benefit you if you execute on some of these things.
And you don't sell, you're still going to come out way, way, way ahead. We recently worked with a company at exactly that. And again, going to that example of the new buyer can do this. They were manufacturing their product, and they knew they could do it for a phenomenally less price, their cost of goods sold. They could bring it way down, raise their gross margin, and bring it way down. They hadn't done it, but they thought, well, the new buyer can do that. We know that we've kind of checked it out, and maybe somewhere in the East, or the Far East, or various other places, we can manufacture and ship it and have it just as good a quality product and do it much cheaper. But we'll leave that up to the buyer. Well, guess what the buyer's not going to give you credit for? The buyer's not going to give you credit for that. That's nice that you know you can do that. That helps the buyer a lot. But you as seller, not to take those steps yourself, you're not going to get any credit for it.
Mm-hmm. Absolutely. So, think about and begin to look and analyze it. What can you do to clean up the numbers? And look, maybe you want somebody to help you take a look at them. We're one group of people that are more than happy to sit down with you, look at the numbers, look at these items, and make suggestions or really ask questions before we make suggestions to see what it is and how you operate and what are ways potentially that you could clean up the numbers. So find somebody to help you look at your numbers, whether you're thinking about selling or not. Every time I've gone through this exercise with somebody, they've said, wow, this was useful, and I've got things that whether or not I sell are going to improve either how I operate or the cash flow of my business. Most of the time, it's both. So I realize we've covered a lot of ground in this video. We've tried to share some examples and talk through some things, but as you can see, how much your company is worth and what it's valued at is really going to vary. And there's a lot of things. Your company is unique. Every company is different. No two are the same, just like no two individuals are the same. So it really takes looking at the inside workings of how your company is operating today, how big are you, how are you generating it, who are your customers, et cetera, looking at all of those things that are going to influence where that valuation might be. And then the other thing is where the market is at this moment in time. If you're trying to sell your company today at this moment, right now happens to be a really good time to sell. The market is very hot. But if you're watching this video and the market might be in a correction or in a recession, that might be a different time, and you might not want to sell them because valuations might be different. So a lot of things that influence it, where we are in the market, what your company is, what's the mood of who are the people buying that specific day. But I'm sure you've got more questions. Reach out to us. Give us a call. We're more than happy to talk through this topic in more detail as it relates to your specific company. So thanks again for watching this edition of Inside the Exit. Please hit subscribe, check out our other videos, And we look forward to talking to you again and seeing you at a future video.
Thanks.